So dividend investing, it's a great way to generate some income from your portfolio, right? But, and this is a big but, there's a really common pitfall that can trap even seasoned investors. It's what we call the high yield trap. And today, we're going to break down exactly how to spot it and, more importantly, how to avoid it.
I mean, let's be honest. When the market is all over the place, that idea of getting a steady paycheck from your investments is pretty appealing. That's the whole promise of dividend stocks. But hold on, because as we're about to see, not all dividends are created equal.
Okay, so first things first. Let's just make sure we're on the same page. The dividend yield, it's just a simple percentage. You take the total dividend the company pays out for the year and divide it by the current stock price. It's like the go-to number for income investors.
All right, so imagine this. You're looking for stocks, and bam, you see a company with a 5% dividend yield. I mean, in a world where your savings account is giving you, what, next to nothing? A number like 5% just screams at you, doesn't it? It looks like a fantastic return.
And yeah, you can totally see why that's so tempting. On the surface, it looks like an easy win, a profitable deal just sitting there. But you gotta ask yourself, is this for real? Is it too good to be true?
And that right there, that's the million-dollar question, isn't it? Is that big, juicy yield a sign of a super healthy company that's just sharing the wealth? Or is it a massive red flag, basically a warning sign of some serious trouble brewing under the surface? This is where we need to start digging.
Okay, this slide breaks it down perfectly. There are really only two paths to a high yield. The good path? That's when a healthy company is doing so well that it keeps raising its dividend payment. We love to see that. But then there's the dangerous path. That's when the dividend is the same, but the company's stock price has totally cratered. The math makes the yield look huge, but it's really just putting lipstick on a pig. And that, my friends, is the trap.
So this is it. This is the heart of the high yield trap. Learning to tell the difference between a real opportunity and a huge warning sign. If you get this wrong, you don't just lose the dividend, you could lose a massive chunk of your original investment. We've all seen this happen. A company's stock price falls, the yield shoots up, investors pile in thinking they found a bargain, and then, boom, the dividend gets cut and the stock falls even further. Just let that sink in for a second. It's the exact opposite of what feels right. That big, shiny number that first caught your attention could actually be a signal to turn and run the other way. So okay, how in the world do you tell the difference?
So, the big question is, how do you protect yourself from falling into this trap? Well, the good news is, you don't have to just guess. There's a pretty simple set of checks you can run to figure out if a dividend is the real deal or if it's just built on a house of cards.
It really just boils down to these three questions. First up, is the company actually making any money? You gotta check their earnings. Second, is real cash actually coming into the business? Don't just look at the accounting profits, you need to look at the cash flow. And finally, and this is the most important one, is there enough cash coming in the door to actually pay out the dividend they've promised?
Look, here's the bottom line. If a company is paying out more money in dividends than it's bringing in with actual cold hard cash, that dividend is living on borrowed time. Sooner or later, that dividend is going to get cut. And when that happens, the stock price almost always follows it right down.
All right, for those of you who want to go a little deeper, let's get into the Advanced Investors Toolkit. We can look at a few extra tools that the pros use to get an even sharper picture of whether a dividend is safe.
Here are three big ones to check out. First, the payout ratio. Basically, what slice of their profits are they handing out as dividends? If that number is over 100%, that's a huge red flag. They're paying out more than they're making. Second, look at the free cash flow trends. Is the business generating more cash over time, or is it getting weaker? You want to see that number going up. And finally, debt. Can the company actually pay its bills? A business drowning in debt has to choose between paying the bank and paying you. And guess who usually wins that fight? Hint, it's not you.
But here's the thing, and this is really the most important part. Whether you're doing the basic checks or the super advanced analysis, the rule is exactly the same. A high yield is only a good thing if it's backed up by strong, healthy business fundamentals. At the end of the day, the numbers have to tell a story of a strong, healthy company, not one that's in trouble.
So we've gone through all this analysis. What's the one golden rule? What's the one thing you absolutely have to remember to guide all of your income investing decisions?
This slide just nails it.
Your job is not to chase the highest percentage number you can find. That's not investing, that's just gambling. Your real job is to find and buy fantastic, reliable companies that are basically cash-generating machines and to buy them at a fair price. The dividend you get, that's just the happy result of owning a great business.
This, right here, is the core philosophy that builds real, sustainable wealth through income. Success isn't about finding some statistical quirk. It's about finding an amazing business that also happens to share its profits with you. Focus on finding a great business, and the income, that'll take care of itself.
So I'm going to leave you with this question to think about for your own portfolio. Are you actually investing, digging into the fundamentals to understand the business, or are you just chasing the headlines? Your answer is what's going to decide if you build a reliable income stream or if you walk straight into that trap.